What's up guys, today we are taking a look at the top 7 high yielding monthly dividends ETFs that you can invest in today. You heard that right, monthly and not quarterly or yearly. This is awesome for those who would like to have a side dividend income or reinvest to compound faster. While the market's been taking a severe beating recently, these ETFs have been providing solid dividend returns to the holders, and my criteria for this list were quite strict, and the most important thing was to see the history of the ETFs to make sure that we're at a positive return when the dividend is reinvested, since no one wants to lose money holding a bag, right? Without further ado, let's dive straight into our list. Starting with number 7, we have Invesco High Yield Equity Dividend Achievers, symbol PEY. This ETF focuses on the stocks of the US companies that have consistently increased dividends over time. So this results in a portfolio that should have a beta less than 1.1 and offer a much higher distribution yield than broad-based market ETFs. If you don't know what beta is, it indicates how volatile a stock price has been in comparison to the market as a whole. 1 is the closest to no volatility difference compared to the market. PEY may be an attractive option for investors who want exposure to equities while simultaneously scaling back risk. Top sectors include financials, consumer staples, and utilities. Top holdings include those which you may recognize like Verizon or Philip Morris. What's great is that the stocks are selected based on dividend yield and consistent dividend growth. The current dividend yield is 3.91%. You may think that this is low compared to some of the stocks, but just remember, earning dividend income is marathon, and this has been climbing up in terms of returns. If we take a look at the average yield since 2012, it's about 3.74%. And if you invested 10,000 back in 2012, your balance will be at 33,612, which is massive. The expense ratio is 0.52% or $52 per year for $10,000 invested. The general rule is anything above 0.45% in expense ratio is considered to be expensive, and below is a cheaper option. But with the high returns, it offsets the semi-high expense. Morningstar's 10-year risk rating for this is 1 out of 5, with 1 being the lowest to 5 being the riskiest. Remember, we're only just getting started and the yield gets higher as we go. Moving on, number 6 is the iShares Preferred and Income Securities ETF, symbol PFF. PFF seeks to mirror the performance and yield of the S&P US Preferred Stock Index. Some of the top sectors include corporate bonds and utilities. Top holdings include these companies, which are mostly comprised of the banks that we know today. And the portfolio of this ETF is well diversified. However, it does tend to favor banks and diversified financials and utilities, which could be risky since it's like putting all your eggs in one basket. The current dividend yield is 4.78% with an average yield of 5.65% since 2012. Your $10,000 invested will be $16,882 today, and expense ratio is 0.45% or $45 per year with $10,000 invested. Morningstar's 10-year risk rating is 4 out of 5 because of how it's primarily mostly of banks and financials. Number 5 on our list, we have Invesco Preferred ETF or PGX. PGX's objective is to replicate the performance and yield of the ICE Bank of America Core Plus Fixed Rate Preferred Securities Index. Someone seriously needs to fire whoever named this one. This portfolio holds more than 200 preferred stocks with a heavy weighting towards the financial sectors, similar to our previous ETF, PEY. Bulk of the companies here are the BBB rated holdings, which means less chance of any default risk. And top holdings include almost all the banks that you know. And the dividend yield is 5.41% with an average yield of 5.78% since 2012. Your $10,000 invested will be $16,687 today, and an expense ratio is 0.5%, which is $50 per year on $10,000 invested. We do have a quite higher expense ratio here, but we do make up for the BBB rated holdings, and the Morningstar rates this 3 out of 5, which is on the average side. PEY and PFF favors heavily on banks, but what if you're a real estate type of person? Well, that's why we have number 4 on our list, Invesco KBW Premium Yield Equity Equity REIT ETF, or symbol KBWY. KBWY tracks an index of small and mid-cap equity REITs in the US and weights on the stocks based on dividend yield. Real estate investment trusts are often publicly traded and more liquid than private real estate, which often have much higher minimums to invest and typically are offered to accredited persons. REITs also have a low investment threshold compared to private real estate investing. But back to KBWY, the top sectors include commercial REITs, specialized REITs, and residential REITs. Top holdings include all these REITs on our list. And the dividend yield is 5.43% with an average yield of 7.37% since 2016. So it's fairly new, and just to be fair, if you did invest $10,000 in 2012, it would be $19,152 today. And the expense ratio is 0.35% or $35 per year on $10,000 invested. Morningstar rates this 5 out of 5, and again, this is due to how the portfolio is heavy on one sector. The portfolio is well diversified in real estate sector, and the current price for this is around $23, which is lower than the $32 range back in February before the financial crisis, so this could be an opportunity to scoop some up. Hang on tight because we are now getting to the top 3 on our list. Number 3 is the Global X Super Dividend US ETF, or DIV. DIV fund focuses on a basket of low volatility, high yielding securities with top sectors in energy, real estate, and utilities. The top holdings are as shown, which you may not have heard of except for Kellogg. This ETF's objective is to track the performance of 50 equally weighted common stocks, MLPs, and REITs within the United States. Securities listed in the index are among the highest yielding in the United States, and they have lower relative volatility than the market. Dividend yield for this is 5.5% with an average of 6.35% since 2013. Your $10,000 invested would be $14,438. The expense ratio is 0.45% or $45 per year on $10,000 invested. Morningstar rates this 5 out of 5, similar to the REIT ETF previously shown. Moving away from the real estate sector, if you're interested in the international market, next for number 2, we have VictoryShares International High Dividend Volatility Weighted ETF, or CID for short. This investment seeks to track the investment results of the KBW Nasdaq Financial Sector Dividend Yield Index. CID operates in the international equity space, specifically investing in large cap stocks that reside in developed markets such as Eurozone, Canada, and Japan. And the 3 sectors are financials, utilities, and communication. Top holdings include these companies, and the monthly dividend yield is 5.66% with an average of 3.79% since 2015. $10,000 invested would be about $11,359 today. The expense ratio is 0.45% or $45 per year on $10,000 invested. Morningstar rating for 5-year risk is 3 out of 5. Although it's a fairly new dividend yielding ETF, this ETF provides investors with a combination of high dividends and low volatility in the realm of international equity. Ladies and gentlemen, we are now on number 1 in our list, which is the Invesco KBW High Dividend Yield Financial ETF, or KBWD. The Invesco KBWD fund is heavily weighted at least 90% towards publicly held financial companies, which should perform better in a rising interest environment. And top sectors include financials and real estate. Top holdings include the following companies, and the monthly dividend yield is a whopping 8.6%. The average yield since 2012 is 8.87%. If you had invested $10,000 back in 2012, it would be $20,107. The expense ratio is also quite low with 0.35% or $35 per year on $10,000 invested. Morningstar rating is 5 out of 5. KBWD is quite risky with significant capital losses and dividends cuts during downturns and recessions. It is quite common for excessively risky holdings to underperform in the very long term, as the capital losses and dividend cuts are simply inconsistent with strong long-term performance. Before we end the video, honorable mention goes to the following ETFs. Global X Super Dividend Emerging Markets, or SDEM, with a yield rate of 10.14%, and Global X Super Dividend ETF, or SDIV, with a yield of 11.31%. The reason these were not included in the list was that the $10,000 invested did not have a positive return even with the dividend reinvested. Now, I do hope you enjoyed the video and found some value in it, and if you're interested in everything that has to do with personal finance and entertainment, make sure to subscribe and hit the bell notification for more videos. See you in the next video.